contract review, guidelines and best practices for logistics providers. Kim, can you advance the slides? There we go. Couple more. Having a little delay here. There we go. So just one back. Yes, so like I mentioned, the contract review and guidelines, or contract guidelines and best practices for logistics providers, that you'll receive a link to this new Roanoke resource. One last item, a brief survey will launch at the end of the webinar, and your input is important, and we really appreciate your feedback. So as a show of our gratitude, those that complete the survey will have a chance to win one of two $50 gift cards in the drawing. Now I'd like to introduce today's presenters. In the interest of time, we will forego sharing their bios, but they will be available in the follow-up email. Our guest speaker today is Nathaniel Saylor. He's a partner with Scopolitas, Garvin White, Hansen & Fury. And he is joining our Roanoke presenters today, Greg Goldsmith and Rick Bridges. I turn it over to you now, Rick.
Thank you, Teresa, and thank you everybody for joining today's webinar. We'll jump right into it. So we call them shipper contracts, master service agreements, MSAs, statements of work, logistics service agreements. They all have different names, but really they share one common goal: to bind two parties together. So we want to go through a fairly candid discussion here of the parts of a contract that folks need to focus on, those areas that really need extra focus, and discuss the perils of a binding contract that includes obligations that can't be maintained. So why don't we jump in with what's the worst that can happen, you know, when a forwarder or a logistics provider accepts shipper terms without input from counsel, without input from risk management and underwriters. You know, just a few examples of that might be loss or damage claims that are the responsibility of the logistics provider for full value without opportunity to limit liability. Insurance might not cover them if not approved. And then the question becomes, can one's balance sheet handle those uninsured claims? I'm going to just turn it over to Grant to give his thoughts on some of the bigger issues that he's seen, the worst that can happen scenarios.
Yeah, thanks, Rick. I mean, exactly what you said. I think the primary concern is that your insurance isn't going to cover a loss that you thought was otherwise, you know, contemplated, you know, by your annual policy, and it would be covered at the time of the loss. We have a lot of clients ask us, you know, if we bought annual insurance and somebody, you know, knew that we were a logistics service provider, you know, why is there no, you know, coverage for these contracts of enhanced liability or these special contracts, whatever you want to call them. And it's generally because until an underwriter has seen something, they don't know it exists. And to the extent that it involved additional liability beyond what you normally do under your standard trading terms and conditions, it's something that they just haven't had the chance to review. They haven't had the chance to perhaps charge additional premium for. And so because of that, most insurance policies have an exclusion for liability assumed under a contract. And that's an active exclusion in there so that we, as the policyholders, tell the insurance companies, hey, we're doing these additional things. We want you to know about them, and we want to get your agreement and support on these things. Let me turn it over to Nathan.
Yeah, and Rick, did you have anything to interject there before I jump in?
Yeah, go ahead, Nathaniel.
Okay, and thanks, Grant, and again, thanks to the Roanoke team for allowing me to present today. Yeah, I think at a high level, you know, what I wanted to touch on this slide really was, you know, to state almost the obvious, right? In other words, it's important, you know, to remember at the outset your contracts mean what they say. And I'll get to the content of the slide here, but when there's a dispute under a contract, it's important to understand that we don't get to sit in front of the judge and tell them, well, it says this, but it means that. And, we don't get to kind of dictate what the terms are. The court follows what's called the four corners rule of contract interpretation, and they're just going to read the contract and interpret it in most instances. And so that kind of now back to the question of, okay, so what's an example of something bad or something that might be uninsured when we just sign a shipper or a customer contract that's been presented to us? And I'll give you a very simplistic example of something that we've seen hit clients very directly right in the checkbook, and that is a contract that says you shall arrange transportation of our cargo. That's simple, which is in just about every contract you've ever seen. If you couple that kind of language with scheduled rates, so we've got a long-term, maybe it's a contract that's on an annual basis, and maybe it's got scheduled rates in that agreement. What can happen is if you get upside down on your rates and you just decide, well, I'm just going to stop handling the freight, but if you don't have a right to terminate that contract, now you're upside down on the rates. Your customer has a claim against you for the spread of what they had to pay to go cover between your rates and what they agreed to in the contract. And that is most likely going to be, I would assume, an uninsured loss. You'd have to have the right type of an E&O policy. You'd have to front that with your insurer, and I would assume that would require some sort of a special endorsement. So, again, from my perspective, I think the takeaway here is, look, the contract means what it says, and you're going to get hung with even a very simplistic provision that says, hey, you're going to arrange the transport of the cargo.
Yeah, that's a good point. One thing I've heard in the past too is between logistics provider and shipper is, well, don't worry about the contract terms. We've got a great relationship. If something goes wrong, we'll work it out. And I remind clients all the time that if the claim is big enough, chances are the person that you're working with at the shipper is not going to be part of that negotiation, suit, or action. It's going to be in the hands of somebody else. So the relationship, while it might be important in the overall business, it might disappear rather quickly when there is a situation and somebody can point at a contract that is binding in that arrangement. So on that note, the next question, if we could move to the next slide, Kim, that would be great. Are contracts negotiable? This is a bit of a rhetorical question, but one to reinforce the fact that contracts from the shipper side are often the best ask of a shipper. They're going to throw that out there, hoping perhaps that somebody signs it and they can be bound to those best case terms. But really, there's often middle ground that can be achieved. My view is there's really no contract out there that should be signed unedited or with at least some desire to modify the terms to get to that middle ground. We recognize some contracts are take it or leave it type of contracts, but that doesn't mean that all of the provisions within that contract should be ignored. There needs to be an understanding of the potential for those exposures to incur significant financial burden to the logistics provider. I'd also suggest that, when redlining the contracts and getting to that middle ground, be ready to state your position on why you have made those changes, because oftentimes the shipper will ask, and in many cases, those changes can be defended. For example, if a shipment is valued no more than $100,000, it might not be appropriate to have a cargo liability limit of $250,000 or $500,000. So just an example of some of the middle ground that can be achieved. Grant, what are your thoughts on getting to that middle ground?
Yeah, no, that's great points. I think we should move maybe ahead one slide, Kim, to catch up. There we go. I mean, we are often told that the contracting terms can't be negotiated. We understand that sometimes they can't, Where they should be negotiated is where the scope of work, does not at all represent what you're doing as a logistics service provider, where your role within the contract is as an asset-based carrier, or some other role that is clearly not your role, which will then have, other legal ramifications. Or again, where the insurance requirements specifically with respect to insurance are outsized, again, with respect to the scope of work. We see these under master service agreements many times. Some of that can be amended, with a specific agreement from the master. But typically, when you're in the world of master service agreements or frame agreements, the insurance requirements, the contract requirements are written to, broadly support everyone that the organization may be doing business with. And we often don't fall well within these sort of catch-all requirements. And so we ask that we at least take a shot at getting the insurance requirements and the contract better modified to what we're going to do, so that we don't leave, the door open contractually to have to answer for situations that we never intended to answer to, based on our scope of work.
Exactly. We spend a lot of time on our clients' behalf looking at contracts, providing that risk management perspective, how a contract might align itself or not with existing policy terms and conditions, things like that. But the caveat that we always add is, please consult with counsel. Make sure that you're talking to not just any counsel, a counsel that understands the contract, understands transportation. So Nathaniel, that clearly throws it over to you. Where do you see some of the issues in these contracts, and where do you think there's most potential for negotiation?
Right. Well, and thanks for the kind words, Rick. I mean, again, I think the leading comment is, hey, the contract says what it means, and when the shipper or the customer comes and says, well, it's not negotiable, like you, our advice is always, well, let's press on that. Let's test it, because I can't tell you the number of times I've honestly heard that from a client that comes to me on a contract I negotiated 3 weeks ago with that same shipper or customer, right? I mean, that, it's contracting season. They put out a bid. They tell everybody, don't negotiate my contract. And then, we start negotiating the contract. So, it's always worthwhile to push. And frankly, you could make an argument that you without pushing, do you look that professional? Do you look unsophisticated if you don't take a run at the contract? And then, that does then bring into the question, okay, so where should we be looking? Where should we be pushing? And it's a lot of the things that you guys have already mentioned, right? It's obviously, we want to make sure that the insurance is right. We need our role as, again, the discussion here is all about forwarders. I'll throw property brokers in there as well. I know you gentlemen would too. Essentially any sort of a non-asset logistics provider. Is our role properly classified? Are we, represented as just arranging the transportation? And we'll get to this more in a little bit in the slides, as far as the risk of not being properly classified. But, and then it's what's the cargo liability we're assuming, or are we assuming cargo liability? And that requires a nuanced understanding of your insurance program and that of the underlying carriers, right? Do we have coverage that is contingent on a claim being made against the carrier and the carrier not having coverage for some reason? Do we have our own separate coverage for liabilities we incur as a forwarder? And if so, is that any liability we assume under an approved contract, or is it something different? In other words, the client needs to understand what they have insurance for, to your points earlier, gentlemen, so that they understand and can explain to the attorney how the attorney needs to revise that clause, or the attorney can obviously work directly with the insurers, as we often do. Obviously, indemnity clauses in the agreement, you're going to want to look there. We don't want to be, in a perfect world, we're only assuming indemnity obligations for our own acts and emissions. And And then it's, there's a lot of other things you'd love to push for. I'm sorry, before I move to those, you want consequential damages disclaimed, obviously. And then, commercial terms are the commercial terms. We'd love to press against offset provisions. There's going to be requests for lien waivers. Those kind of take it or leave it. But I think the big ticket items that really hit the risk in the insurance profile are what I just mentioned. And then if it turns out it's truly not negotiable, or it's not negotiable in good faith, in other words, we just can't make headway, and it's just a question of, all right, do we walk, right? I mean, in other words, if the contract's truly that bad, and that, obviously nobody wants to be in that position. Nobody likes to walk away from business. And we're in an environment right now where the market's tight enough that you shouldn't have to. A non-negotiable contract is probably a negotiable contract right now. But I think, it's important to understand in the company, every company ought to understand its own risk tolerance. What am I being asked to take on? If I don't have insurance for that, am I willing to assume that liability? Rick mentioned earlier, if this hits the balance sheet, are we comfortable with that? And so again, each insured needs to understand what its tolerances are, what its, what's the opportunity that's on the table, and as we've all heard, is the juice worth the squeeze?
Yeah, it brings up a good point. Drawing that line in the sand, that walk away point, and I think it's critical within that negotiation to bring in all the parties within your organization to come up with a full understanding of why that line is drawn in the sand. So, not just sales. Obviously, the sales team is typically bringing these contracts to management to look at, but the entire C-suite, I think, needs to be part of understanding the upside and the downside to these contracts. Operations, can operations handle some of the requirements of the contract? Can it be performed in a way that the shipper is going to be satisfied? And then obviously your outside partners, whether it's us, insurance brokers, risk management, trade counsel, all those parties, I think, work together in unison to hash out that middle ground, hopefully, or at least outline the pros and the cons and the components of that contract that either make it viable or make it one that you do have to walk away from. And I think in opportunities where a contract cannot be perfected and you do have to make that call, there's always someone, in many cases it's on the sales side, that may come back and say, well, a competitor is doing that. They've signed that contract. They might have signed the contract, but that competitor might be sticking their neck out. They might not have as good a counsel in providing guidance to outline all the exposures in that contract. So it happens. It's very real, and there are opportunities that do not get perfected, but really as a means to protect the company from further exposures.
Yeah, that is a fantastic point. I would just, to put a pin in it if I could. You're right. The clients that do this the best are the ones that have a top-down understanding, of when are we going to walk away and why. Both so that the owners of the company can sleep at night, but also so that the people within the organization understands, hey, there's real risk here. We really look at these things and we make an informed, decision. And I think to get that understanding in the sales force is helpful, so that they don't feel like they're just, being ignored. I mean, they worked hard to get that contract in place, or at least to get that opportunity in front of the company. And, I think if there can be that top-down understanding, that helps a lot.
Yeah. I mean, we're all sales organizations in some degree, but at the end of the day, it has to work to maintain profitability of the company. So that's really what it comes down to. Okay, so switching gears a little bit, Kim, if we can go to the next slide. So why do contracts need approval on most insurance policies? The short answer, as Grant stated earlier, they're increasing liability and or cost to the logistics provider and their insurer. The insurer rates a policy based on the known exposures, typically at the beginning of the policy year, and not necessarily anything new that changes those exposures. And the other consideration is remember that an insurance policy is a contract as well, and there are specific terms within the policy. Those might need adjustment to accommodate a new contract. Grant, what do you have to add on this piece?
Yeah, I would say, it's one of the most infuriating points, probably, I think, of having an insurance policy and this line of, where did we go beyond our normal risk into risk that we only assumed under a contract that would not have been our normal operational risk. And that's probably the main line for underwriters. They understand, generally what you're doing is business. They agree to insure your business. You completed an application. But where we get a contract from a shipper or a warehouse partner or a client, and we're now asked to assume liability that we normally would not have had. And so it's liability that we only have because of the contract. That's where insurers make the distinction of, hey, we are excluding liability assumed under a contract. They don't necessarily mean if you signed a contract, then what you're doing normally isn't covered. What they mean is if you picked up enhanced liability or liability that you would not have normally had, that you only got through this contract, we are not accepting that. And again, it's the only way they can control this idea of notice, where they're excluding it so that you give them notice where you are in a situation where you picked up, enhanced liability. And I mean, the short answer on enhanced liability is that is defined as anything beyond your normal trading terms and conditions. And, people say, well, I see that every day. I see a shipper contract every day. I see a warehouse and logistics contract every day. And there's probably some enhanced risk in there. And I would agree with you. We see it more and more and more. Which is why it's so important to have an internal contract risk management process that allows you to understand that it's in there, get it to your legal counsel, get it to your insurance broker, who can ultimately get it to the insurers, so that when you are ready to sign this contract, you've gotten the other parties informed, you've gotten their commentary, and you've gotten agreement from the insurance company with respect to what extent they're going to insure it. In the absence of having informed your insurer about any contract of enhanced liability, your assumption should be that you're a prudent uninsured, that you haven't told them about this, and so they don't know about it, and so you don't have coverage for it when it involves enhanced liability.
Good points. Daniel, do you have anything to add on that one?
Not much. I mean, obviously, this is really hyper specific, I think, to the insurance relationship. The only thing I would add is obviously that, the huge benefit in addition to everything that was just mentioned, of just, as an example, when my clients frequently, and, I don't know whether I'm going to let you guys peek behind the curtain a little bit. My clients obviously, don't always say, here are my insurance policies, review my policies in conjunction with my contracts. And in fact, I'm not sure any of my clients want to spend the time and the money required to do that. And I understand that. I don't blame them. And so my point would just be from the legal perspective. When I'm revising a contract, I'm usually telling the client, hey, make sure that you have the insurance provisions reviewed by your insurance professionals to make sure that there aren't gaps, even silly things like, well, it says we're going to name them as additional insured or provide waivers of subrogation or lost payee status. But as an attorney, I don't care much one way or the other, right? Just let me know if you're going to do it, and then I'll make the indemnities consistent, et cetera. But I need to know if you're going to do it. And so you need to understand from your insurance professionals whether there's a cost associated with that, whether you can't get it done, whether you just don't want to get it done. And then let me know how you want me to revise the agreement. So it's that kind of push and pull, or that, having everybody at the table and reviewing and being on the same page really helps.
Definitely, yeah. And that part that you might not see is that cost component to the insurance. That could be the premium, it could be the deductibles that the underwriter is not willing to move on, so thereby assumed solely by the entity that's signing the contract. These are the issues that we spend a lot of time on, really designing something that works not only to cover the exposures, but to be a final product that works from a cost perspective. Because ultimately, the added costs are not necessarily going to be something that you can pass downstream to the shipper in whole and be competitive in that contract. So it's a little bit of a balance, and all the parties really need to come together to make sure that liabilities are fleshed out, the insurance is there to potentially cover those liabilities, and at the end of the day, the costs are really added up to ensure that they're going to make sense in being able to handle this contract that you're looking at.
Let me just add, Rick, I think there's
Yeah.
fewer and fewer insurers today, especially in the hard market, that have the bandwidth on the insurance company side to even review the contracts that we send through for review. So it's often not a fast process, and from a amount of work going on on the insurance company side, I don't know that they have someone on staff who's just waiting to get the next contract to review. You're often having to get it to an underwriter who may be working on 1,000 other things. And again, if it's got some meat on the bone and there's some topics that we have to discuss and agree on, the lowest common denominator in terms of time is often the underwriter. So whereas our client, our insured, can get the contract to us somewhat quickly, and where we can review it as a broker, and maybe where legal counsel can review it, often the person that takes the longest amount of time to review the contract and perhaps upstream it on their side is in fact the underwriter at the insurance company. And we see them, continue to be constrained in this hardening market with, less and less time to work on those important topics.
Yeah, good points. We're helping the insured, the client, on the negotiation with the shipper, and at the same time we're doing our own negotiation with the underwriter, and that can be frustrating at times as far as the amount of time it does take to get there. But definitely good points. Shifting gears a little bit downstream, Nathaniel, you mentioned the carriers. What about the generic subcontractor agreements? This is an area that I see quite often as problematic. It's something where oftentimes I see it when a claim is being presented, not when a contract is being presented. Someone has gone out and signed a contract that is a generic subcontractor agreement that it could be building maintenance or outsourced HR also has to sign. Some of these I see provisions within them, such as the party has to sign basically accepting any and all liability to property damage, things like that. What are the issues that you've seen, Grant, with any of these contracts that might come up that might look innocent at the start?
Yeah, I mean, a generic subcontract agreement can be, easy for us to get through if it was properly written to a logistics service provider sort of scope of work, or it can be, one of the most onerous things, we've ever seen. I've seen subcontractor agreements that were clearly meant for someone who was going to engage in construction operations, where it's important that the insurance has products and completed operations coverage, and where the insurance shows a per location aggregate, which again are common in construction concerns, but really not relevant to logistics concerns for the most part. So a company or a partner that's trying to use a one-size-fits-all subcontractor agreement can really be a difficult thing to work through, because the amount of red ink changes that we want to make to that agreement in order to get it palatable for what our client is in fact doing as a logistics intermediary is a lot of red ink. It's almost easier to start from scratch than to mark up a subcontractor agreement that's written for any subcontractor that sets foot on your premises. So I mean, I'll turn it back over to you, Rick, but I mean, it can be very difficult to get a generic subcontractor agreement and cut it down to properly meet what we're going to be doing as a logistics intermediary.
I've found that we've had some clients that have been successful weaving in reference to their own terms and conditions and limitations of liability. Nathaniel, in your perspective, does that work well enough to give at least some comfort to the logistics provider that their terms will prevail?
Right. So that's a good question. I mean, so what we've got here essentially is an agreement that's not specific to forwarding. And as we redline that agreement, the thinking is, well, let's refer to our own terms and conditions of service. And, from an attorney perspective, on the one hand, I'm not in love with that approach. I'm going to just to highlight, I'm going to say, yes, let's do that if we can. But on the one hand, you're not necessarily in love with that approach because it does set up maybe a conflict between the two documents. Because that clause usually has to say something like, well, in the event of a dispute, one or the other governs. Now, the issue from the forwarder's perspective is the customer is going to say, well, the signed contract needs to govern. And that's, probably right. Like, in other words, that why would I sign a contract if it's going to be superseded by something I haven't signed? And if the customer demands that sort of language saying that the signed agreement, in the event of a conflict between the forwarder's terms that are cross-referenced in the agreement and the main agreement governs, then we're kind of right back where we started potentially. At best, what we've got is now some ambiguity as far as, well, is this even a conflict between the documents? If so, whether and to what extent do we have a conflict? So now if we can get it to say that, hey, the forwarder's terms apply and they supersede, then absolutely, that's preferable. I think in a situation where we can't get that done, Rick, you noted this and the way you asked the question. A lot of times my clients will say, well, look, this is really easy. It looks pretty favorable. And they'll send me one of these short, subcontractor agreements. And they'll say we're not even liable for cargo because there's no cargo provision in the agreement. Right. Well, this is America. Anyone can sue you for anything. And the fact that there's not a cargo provision doesn't mean you're not liable for cargo loss and damage. And to your point, there's probably some language, usually in the indemnity if nowhere else, that says you're going to indemnify against all sorts of claims, including bodily injury and property damage. Well, property damage sounds an awful lot like cargo loss and damage. So there are certainly things you want to push on, in these generic agreements. To Rick's point, if we can get the customer to agree that our terms and conditions govern and they supersede to the extent of the conflict, that's ideal. We can't get that done. Then again, it's the things we kind of touched on, so I'll briefly just reiterate. We need to lay out our role. Our role is to arrange, not perform transportation. We need to have a cargo loss and damage provision in there that caps our liability for cargo loss and damage. And again, we want to look at, we don't want to be on the hook for indemnifying against third parties' acts and omissions. And we want consequential damages waivers as at least kind of the bare minimum that we want to add into that agreement that's probably not there.
Yeah, it's a good summation. I've always said in the absence of clarity, there's cost, and you don't want to get into a point where you're mired in defense and argument over a claim. We've seen situations in which that does occur, and hundreds of thousands of dollars can be spent in defense. And along the way, you've lost that relationship with the customer. So all that work that you've done to perfect that contract is out the window. and in many cases, so is the client. So it's really critical to get it right up front. So that kind of segues to the next question. Are you signing the right contract? Are you being asked to sign a carrier contract when you're not the carrier? Grant, I'm sure you see this as much as I do. What's your perspective on the frequency of this kind of thing?
I think probably the thing we see most is where, we're a property broker, we're an intermediary, and we're asked to sign a carrier contract. That's still, very common. It can get confusing too for the insured, which may have a asset side of the business and a non-asset side of the business. And so it's not unusual for them to get a contract in that identifies their operations as carrier, because on one side of the business, they are the carrier. It just turns out that on the side of the business that's handling the contract, that's the non-asset side of the business, separately insured. And so they're not the carrier in that case. So, who you are in the contract and having people on staff that understand, oh, this is a carrier side contract, I can be a carrier. This is not a carrier side contract, I can't be a carrier. A contracts management person, a contracts management, department is key if you're going to perform both asset and non-asset, functions within the same organization. But what we look at when we get contracts in is typically, what's the scope of work? Is it a scope of work that we're actually doing, or is it generically, everything under the sun? How are we, the insured, identified within the contract? Are we a logistics intermediary? Are we a carrier? Are we somebody who's not even a carrier? And then we sort of, once those two things seem to be in line, we'll go to the insurance provisions. And then to, Nathaniel's point, we'll take a look at indemnity to see whether or not, sometimes we're comfortable with the insurance provisions, but then you go to the indemnity section and that sort of, adds everything right back that wasn't in the insurance provisions. So we're still responsible for everything through indemnity, even though we weren't required in insurance. And I often remind people that the insurance requirements are the minimum requirements. So if it asks us for $1 million in general liability or something like this, that's the minimum requirement. That doesn't mean they're going to not sue you or not ask you to be responsible beyond those requirements. Those are minimums, unless of course there's negotiated caps within the contract, which often there aren't. So how we kind of coordinate who we are under the contract, how we coordinate the limits, how we coordinate the indemnity, and how we get that, pushed together into a well-written agreement, is to me just so important. It's the number one when people ask me, what can I do to focus more on risk management? I would say, well, other than the safe operations of what you're doing, probably the most important thing you can do that you're not doing today is focus on your contract management.
That's a good point. And, I see that a lot is maybe the assumption that the insurance limits are the liability caps, and by no means are they. It can be a dangerous situation to make that assumption. Nathaniel, let's go back to the starting question here in light of the contracts that might be improperly signed. Contract carrier versus forwarder. What's the worst that can happen? Where have you seen situations here?
Yeah, I mean so the thing that scares me the most, and we have seen litigation on this, is the impact of signing the wrong contract in the highway accident litigation context. In a highway accident litigation claim, so in other words, assume that the 3PL forwarder broker signs a customer agreement, brokers or tenders out a load to a third-party carrier. That carrier is involved in a highway accident, and so now there's going to be a claim by a third-party plaintiff. That third-party plaintiff obviously is a stranger to any contract that was signed. There's no, even if there was a cap on liability under the contract, in the Grant's point, there's typically not, and that insurance provision is not a cap on liability. It's a great point. Even if there was a cap in that agreement, it's not binding on that third-party plaintiff, as you gentlemen understand. And so here's how that plays out in reality in the courtroom. we have a contract that we freely sign, we being the insured, that says we're a motor carrier. And it doesn't just say that. There will be dozens of representations in that contract about providing the equipment, providing drivers, providing authorized drivers, properly licensed drivers, drug and alcohol screening, compliance with federal motor carrier safety regulations. All of those things are going to be contractual requirements that we've agreed to. And to my earlier point, that's going to be evidence, right? We don't get to sit there and just tell the court, oh, well, don't ignore that contract. It doesn't, that's not really who we are. That's not really what we do. The way that that plays out in litigation as a practical matter is it creates what are called questions of fact. We're going to have a question of material fact when we say, the plaintiff is going to say, here's the contract. I want to put this in front of the jury because it says all these things about what this 3PL was doing. We're going to say in a deposition, no, that's not what we were doing. The contract's not accurate. And now we've created what are called material questions of fact. And what that means is we're not likely to get out of that suit at what's called the summary judgment stage. Summary judgment basically means the court decides who wins as a matter of law because there are no questions of fact. We're not going to get out of that case by arguing, well, we're just a 3PL and we shouldn't be in this suit. We're going to be in the suit most likely, and again, that has resulted in the 3PL. I can think of one case, I won't name names just in case anybody's on the webinar, but it was a $15 million judgment against a 3PL where there was the plaintiff just hammered them on the fact that they walked and talked like a carrier.
Yeah, I mean, and the judgments are huge. We see this all the time. Contingent auto insurance is now, unfortunately, a necessary evil to, in some way, manage those exposures. But even with that, oftentimes those insurance limits are not enough. What tempers that is the cost of the coverage. So really, again, getting these things right at the contract stage are critical to minimize that exposure.
Yeah, that's a great point. I mean, I think ultimately you're right. We've got runaway jury verdicts. Clients always ask me, well, what's the biggest verdict you've ever seen against a broker or a 3PL? It doesn't matter. What the biggest verdict you need to be worried about is the biggest one ever against a motor carrier. And there are, 9-figure judgments against motor carriers for highway accident liabilities. And as a broker, you could be pulled into that suit. Again, if it happened to have been a brokered load. So, to the points earlier, there's no cap. Those insurance limits aren't caps, and these can be. This is a tough one, and it's a frustrating one as an attorney or as a risk manager because you could say, well, yeah, the likelihood of a claim is low, but the reality is, if there is a claim, it's going to be a bell ringer. If we're talking highway accident liability, it could be a hand over the keys type liability. So. Maybe low risk of occurrence, but if it does happen, it's potentially huge exposure.
Definitely high severity. Yeah. Okay. Thank you. So the next question, next slide, Kim, if we can go to that. How are you managing subcontractor requirements in the contract? This kind of shifts the discussion to what reliably can be pushed down to the carrier. Often these contracts include language where there are performance standards, insurance requirements, prohibitions on limitations of liability of the subcontracted carriers. Questions are really, can you reliably manage and enforce that? And what happens if you don't? Grant, I'm sure you see this in a lot of the contracts that you look at. What are your perspectives there?
Yeah, I mean, we will have a handout after this, but again, I think it's important to have a contract management process and to follow it just to, keep some sanity, in the, how you're going to go from step 1 to step 2. I think it's important if you're going to sign a contract with enhanced liability and there is maybe not, back-to-back insurance coverage, where the company's assuming risk, that you have a meeting, you have an informative process by which, the operations side, the sales side, says to the ownership side, hey, on this one, we don't have the cover of insurance either on any of it, or we only have cover of insurance on some of it. Do we want to proceed with signing this agreement, entering into this business, is it worth it? In some cases, it will be, because perhaps the risk of loss is low. And even though we don't have insurance for it, we've taken other steps through maybe contractual means or other steps to mitigate loss. And so we go forward. But where we see large problems is where, because there is no contract management process, that uninsured risk went unidentified. And it only becomes identified, after the loss, when we realize we don't have the insurance dollars that we thought we had to finance either the defense of the claim or, the award of the claim itself.
Yeah, good points. Nathaniel, I'm sure you've seen this too, and I've seen some contracts out there that I think in many ways ask too much of the intermediary. At what point do some of these contracts do overreach and potentially expose the intermediary to that highway accident liability?
Right. Yeah. And again, I think when we think about, all right, so I've got a shipper contract and it says, well, here's all the, dozens of things that, and oftentimes it's, the carrier has to comply with, right? So you see this all the time in food shipper agreements, as an example, where they want hyper detailed. I'm looking at one now, actually. I was looking at it this morning. It actually literally cross-references manuals. Like the shipper has not only exhibits to the agreement, but then it's got manuals of this is how you handle my stuff. And, there's a couple issues there. And I'll try to be quick, and I know we're trying to save some time for questions here. What we want to do, you start with a well-drafted carrier agreement. That should anticipate the vast majority of, and when I say a well-drafted carrier agreement, what I mean is one that anticipates customer demands. And so now what we're talking about is, okay, now we've got customer demands that go beyond what, we could possibly reasonably anticipate. And there's a couple options there. If there's not many and it's an important customer and we have a robust TMS, there's a way that we can just automate the load confirmations that go to the carrier to include some very specific, hey, for this, every time it's for that customer, it populates some instructions that come straight from the customer. Great. But if it's beyond that, I strike it in the contract and try to just get it out and explain that, hey, this just isn't something we can manage for you, and try to get that done. If we can't, then you're talking about kind of a, trying to limit the number of carriers that service that customer and having them sign a customer specific addendum. That's unwieldy. It limits, capacity, but those are options. But then, Rick, to your point, at some point, we're kind of dictating the carrier's operations, right? And we can point back to the shipper and say, well, these are all their requirements. Don't impute that control to me in a highway accident context. But the problem with that is we're probably indemnifying the shipper potentially for those claims. And so it's a vicious circle.
That's a tough one. Okay, in the interest of time, we're going to go to a question of valuation. Why is valuation so important? Obviously, the contract might reference it. It could be replacement cost, invoice value, things like that. The question I always ask, is it clearly defined? Is there literally a definition of valuation that's being put forth by the shipper? Clearly this is important because it could mean a contract requirement pays out for $10,000 replacement cost value. The sales cost of that same shipment could be 200% more than that valuation. Grant, how do you try to get to a middle ground there?
I mean, we want the valuation to agree with, to the best extent possible, to what our standard trading terms and conditions are, or to what we are able to offer from an insurance standpoint. So there's so many ways to approach valuation, and there can be a release value, there can be a value per pound, a value per package, a value per container, a maximum value up to a limit. It can be replacement cost value of the cargo. It can be the sale price of the cargo. If we're in peak season and we're, delivering right before Christmas, there's so many ways to approach valuation. The good news is the insurance industry generally will allow for all those ways to be met through an insurance product. The problem is there's generally not one insurance policy that acts as a Swiss Army knife for all forms of valuation. Things less than full value tend to be something we handle as liability. Things that approach full value and beyond full value tend to be things that we insure under a cargo policy. So because the industry is a little bit split in how it wants to handle lower valuation versus, full value valuation, it's important for us to, in discussions with the client and in review of the contract, to understand what our valuation responsibilities are so that we can make sure that the insurance policy meets the expectations upon claims payment with respect to valuation.
Gentlemen, that's a really good segue into one of the audience questions, if I can go ahead and ask that.
Sure.
Okay, when provisioning multiple distinct services, including possible customs brokerage, freight forwarding, indirect air carry, and Vocc, warehouse operator, each with own parameters, is it better to try to mold one super contract, avoiding overlap, or better to have separate contracts?
Good question. I think probably the three of us could argue for a full day on the merits of both answers. Nathaniel, this is more in your wheelhouse. Why don't you start?
Well, but thank you for the lead in, right? Because that's spot on. The difficulty here is that what we have in the logistics space are a bunch of, as the questions say, we've got customs brokers and Vocc. Everybody's got maybe legal. There could be conventions that actually govern your liability for loss and damage, depending on what hat you're wearing. So if you're issuing airway bills, showing you as the carrier, and it's international freight, you're going to be subject to the Montreal Convention. Ocean bills of lading, you're going to be subject to the Hague Rules, Carriage of Goods by Sea Act. There are industry standards in the surface domestic freight industry. And so a single contract that governs everything is very difficult to draft because there's going to be overlap on every one of those moves too, right? We can say, well, if we're a property broker, it's this. For an NVOCC, it's that. Well, guess what? There's going to be a surface move on every one of those air or ocean moves as well. And so it is quite difficult to have a single agreement that addresses everything, that addresses the overlap on intermodal moves. Especially if we are issuing bills of lading, airway bills, where we have some legal liability that's dictated to us. If we don't, and we're truly acting as like the non-asset kind of travel agent type forwarder, the industry standard kind of NCB, FAA trading conditions are not a bad place to start. An option here would be, and I've had some clients go this route, would be kind of a short form MSA that says, hey, there's going to be schedules to this document, and when we're providing this service, that schedule applies. When providing that service, that schedule applies. So warehouse, versus and Vocc as an example. You can try to skin the cat that way, but you kind of get back right into the same overlap. Well, where did this loss fall? So it really is. It's a difficult question for forwarders. Obviously, the best scenario to be in is to have well-drafted terms and conditions that talk to one another. That's one of the things I think a lot of standard trading conditions fail to do, is talk to the different, hey, do my standard trading conditions talk to my ocean bill of lading? Do they talk to my airway bill? That's not going to be perfect, but what it allows you to do is say, well, I think this applies. And if you don't think that applies, then it's this. And either way, I get 2 bites at the apple to defend myself.
And at a minimum, make sure they're not conflicting with each other.
Exactly.
I can see how that would be a several day long discussion in detail, but we don't have that much time today. So how about another one? What constitutes a contract? You're discussing priority of contract versus standard terms when a customer generated document addresses service level agreements, but avoids other components of a contract, such as indemnity, loss limits, jurisdiction, etc. Can't these service level agreements coexist with standard terms?
Good question. I leave that to our attorney to fully address.
Again, it is a good question. And I think the answer is yes. So what is a contract? Let's start there. It's essentially, it doesn't have to be written. It doesn't have to be signed. It's essentially, a meeting of the minds between the parties. And so here in the example, we kind of have a, almost an SLA type document. We've got pricing, but it doesn't have any sort of terms and conditions. And so obviously in an ideal world, we would say, well, our standard terms and conditions as a forwarder apply, and that's just the pricing and some of the other aspects of the relationship. And that's a pretty good argument to make if we have done the right types of things to get to be able to show a court that we got any sort of customer assent to our terms. So in other words, as a forwarder, what we want to be doing is we want to have our terms and conditions on our website. We want to reference them in any credit application. We want to have every new customer sign a credit application. We want our documentation to always refer to those terms and conditions. We want our emails and especially load confirmations, shipment specific communications to refer to a website where those terms and conditions are at. Now what we've done is we've given the court an ability to say, okay, I think there is a contract here, right? Because the court, otherwise they're looking at this SLA document, and the court doesn't want to be in the business of creating a contract between the parties. So let's give the court what the court needs, to essentially punt and say, okay, here's the contract. It's the forwarder's terms and conditions. And then obviously, just to put a pin on that, the trick with the signed contracts, obviously, is usually there's a merger clause in there that basically says, if it's not in this contract, it is not part of our relationship. It's not binding on the parties. And so that's how they disclaim your default terms and conditions in a signed contract. Even if they don't say specifically your terms and conditions available at www.whatever don't apply, you've usually waived it in that signed contract.
All right, good. Thank you. In the last couple of minutes we have left here, or 1 minute, a couple of insurance questions. What types of policies do I need to be concerned with? And is there a chance to purchase short-term professional liability?
Good question. I guess the first part of that question, it's really going to depend on the exposure, whether it's a contract, what you're doing for that particular customer. It's really important to sit down with your risk advisor, insurance broker, and be candid about what you're going to be doing, not just today, but in 6 months and in 12 months. So the broker has a full understanding of the insurance that needs to be crafted. There's, unfortunately, for a logistics provider, there's no one magic policy that covers all the exposures. Oftentimes, it's many policies that overlap each other. And at times, there might be specific coverage that can be purchased for particular projects. That can be done on a per project basis. The professional liability aspect, it's typically best purchased on an annual basis, and then maybe slight tweaks are made along the way to better respond to those particular projects or individual shipments.
Okay, good. Any quick thoughts before we close, gentlemen?
I guess the one thought I would throw out there is, really make sure you have open, honest conversations with, transportation counsel, with your risk advisor, with your insurance broker, to make sure that they have as full a picture as they can to help provide a solution to cover those exposures.
And I would say have a process by which you're evaluating contracts. Again, if you're looking for, a template, we will, provide one here with this briefing, but it's important to have a process just so things don't go unevaluated.
Yeah, and the only thing I would add to that is to reiterate what Rick said earlier, top-down buy-in, across the company, understand what your risks are, what you're willing to take on, and what you have insurance for, and that's going to help you identify those excess risks.
All right. Thank you, gentlemen, for a great presentation. There was a lot of information shared. Again, you will be receiving a link to the webinar and along with the slides and some of the questions we weren't able to get to, but we'll do our best to answer those after the webinar. Thanks again for joining us. Please be sure to complete the brief survey and be entered into our drawing. Have a wonderful day, and we'll see you next time. Thank you.
Thanks, everyone. Thanks, Kim. Thanks, Teresa.
Thanks.